Hello, my name is Joe Hoyle, and I am one of the co-authors of the financial accounting textbook that you're using in this course. In this video, I want to talk about investments that one corporation will make in another, that they'll buy stock in some other company, and that has to be recorded. So to give you an example, I'm going to set up a problem here, and then you and I will work this problem to see how it's done according to US GAAP. During year one, Ace Company holds $100,000 in cash that will likely not be needed for 2 years. So they've got $100,000, they're holding it, they don't need it right now. The question is, what are they going to do with it? Interest rates are low, so there's no reason to put it in a savings account, and it really will not make much money if they buy a bond. So company officials decide to invest the money in the stock market, hoping that they can use this $100,000 to make an especially good return on their investment. Ace goes out and buys 2,000 shares of Zolang Inc. This is a company I made up for $50 per share. Ace hopes the shares will appreciate in value because, of course, that's one of the reasons that you buy stock, is because you hope that it will go up in price. And also they hope that Zolang might distribute a cash dividend. For an investor in a relatively small amount of stock, those are the two ways you can benefit. The price of the stock can go up and you can sell it and make a profit, or possibly the company can pay a dividend. So when you make an investment in the stock market, if you're buying a relatively small amount, then this is what you hope is going to happen. We get to the end of year one, and now the shares are worth $130,000. They've done well. They paid $100,000, and now the stock is worth $130,000. In year two, Ace receives a $3,000 dividend. Apparently, the price of the stock goes down because then they only sell the shares for $110,000. They bought them for $100,000. They went up to $130,000. They went down to $110,000. At that point, they sold the shares. So from an accounting perspective, what is reported by Ace? A fairly common situation where a company has bought an investment in some other company, and the price of the stock went up and down, and they received a dividend. How is this going to be reported by Ace Company? Before we get started, I simply want to make a comment because I think this will be helpful. A lot of times in school, students just think that all of this is made up, but this is a normal problem. Businesses often generate enormous amounts of cash. And I want to give you an example of that. So I went and looked up Apple's 2020 annual report. And I found fairly quickly, once you know how to find the information, it's there to be found, that the average net cash inflow, and that would be the cash that comes into the company less any cash that went out from operating activities. So you can understand what the operating activities of Apple would be. On a daily basis, they receive $220 million. Wow, isn't that an amazingly large figure? If you were working for Apple, if you were in the treasurer's department, for example, you would have to figure out what to do with $220 million a day. That just boggles my imagination, trying to keep up with that much cash. So one of the possibilities is that they could use this money to buy the stock of another company. Like Ace has bought the stock of Zolang, they could use some of that money to invest it until the money is needed in this case. Eventually, they may buy another company, they may pay a dividend, they may pay bonuses to their employees. Who knows what they're going to do? But until they need that money, they need some way to make a profit with it. In this case, Ace has bought the stock of another company. Not at all unusual. So let's see what we can do. Here's kind of the theoretical discussion of this issue. Many investments or many assets are not reported at fair value. Now, a lot of times when students enter an accounting class, they assume that assets are reported at fair value. That's simply not true. About the only time that most assets, not all, are reported at their value is when they have been impaired. So for example, if you have equipment that's impaired in some way, then in that particular chapter, we looked at how you determined that impairment loss. Why do you not pay more attention to fair market value? Why do you really not look at fair value? And I can give you a couple of reasons. First off, fair value can be very hard to determine. What is the fair market value of a piece of equipment? What is the fair market value of a large computer? Well, we could kind of come up with that, but it's not very accurate. It's more or less just a guess. And accountants, as I have said before, don't like guesses. So therefore, fair value is just a guess, and that kind of turns accountants off. Secondly, or plus, most assets are not held for sale. If you have a machine and you don't plan to sell it, why do you want to know the fair value if it's not going to be sold? And most of the assets in any company are not on the market to be sold. So therefore, although you might believe that fair value is important, accounting doesn't pay as much attention to fair value as you might think. But I'm going to give you an exception now. Most equity investments, so purchasing shares of Apple, for example, or purchasing shares of some other company that can be sold immediately and the value is known, is normally going to be reported at fair value. So if you have shares of one company, Coca-Cola, for example, you can easily look up on the internet, find out the value of those shares at this particular second, and know for a fact that you can get that money by selling them on the stock exchange. Now, not all stock is like that, but an awful lot of stock is, that you can get the money immediately and you know how much that money is. So for that reason, US GAAP reports this asset, and that is investments in equity securities, as long as it's only a relatively small amount, is reported at fair value. So when ACE buys the shares of this other company, then they're going to report the investment in Zolang at fair value. Most assets aren't done that way, but investments in equity securities are. Now, let me make one quick explanation. I said that this is the method we use as long as you only hold a small amount of the other company. Because at some point you own enough that you can kind of take charge. The general rule is, and this is kind of a general rule, that as long as you don't own 20% or more, that you own 2% or 4% or just a few shares, then that's going to be reported at fair value. If you go up above 20%, you're probably going to use a different method of reporting. But most of the time, and I do mean most of the time, when you buy shares of another company, you don't buy 20% of the company. You buy just enough shares so that you have a little bit of the ownership, but not 20% of the ownership. But that's what we mean in this case by a small amount of ownership. So here's the first entry. Year one, ACE buys the investment for $100,000. So therefore, the assets recorded at $100,000 and the cash is reduced to $100,000. The asset is worth $130,000 at the end of the year. And I wanted to ask a theoretical question here. We know that it was bought for $100,000. That's easy. We know that the value has gone up to $130,000. So the value has gone up by $30,000. Can you report that $30,000? And the reason I raised the question is that that $30,000 is not assured. You will not know for certain how much gain you're going to have until you sell the stock, and they have not sold the stock. So 30,000 is the gain so far, but that investment could certainly go down in value and not have that gain. So can you recognize that gain before you actually have it assured? And remember, I think this is important, accounting is somewhat conservative. So typically in accounting, you cannot recognize gains until you're sure you have them. This is a $30,000 gain, but you're not sure that you're going to have this. If you hold the stock a while, it certainly might go back down in value. Well, here's what US GAAP has to say. Because the fair value is known and the money can be received easily, fair value is reported for small equity investments. And again, small is under 20%. Thus, since you're going to report this at fair value, the gain is reported. Now, there's a lot of people, when this rule came out, did not like it. They said that's not conservative accounting. You cannot recognize a gain until it's assured in financial accounting typically. But FASB disagreed, and FASB said it's more important to recognize this stock, this investment, at its current fair value of $130,000. And the only way to do that is to recognize that gain of $30,000. To let decision makers know, they use the term unrealized. That means that the stock has not yet been sold. And so therefore the stock could go back down. That's kind of a warning. We're going to recognize the gain. Yes, we are, but it's not yet assured. It could go back down, but that records this investment at its fair value of $130,000 and records the unrealized gain of $30,000. If you're taking notes, that really is the core to recording investments in equity securities as long as you hold only a relatively small amount. You adjust them to fair value and you record an unrealized gain if it goes up or an unrealized loss if it goes down in value. That's the rule. That's US GAAP. Later, of course, in year 2, a dividend is received. That's simply an income. I simply wanted to put that in here. Year 2, they receive cash of $3,000. They have dividend revenue of $3,000. Nothing odd about that, but I thought it was good to see that how they handled the $3,000 when they received the dividend. Now, later in year 2, they sell the investment for $110,000. They bought it for $100,000. It went up to $130,000, and now it has gone down to $110,000, and you sell it. So what do you do in this case? Now remember, they bought it for $100,000 and they sold it for $110,000. So the real gain is $10,000. So we put on the books $110,000. We take the investment off the books, but the investment has been written up to the fair value of $130,000. Since it is now sold, the difference is a $20,000 loss. And notice it doesn't say unrealized loss. This is the loss because they sold the stock. They made $10,000. I find this interesting. They made $10,000 profit. They recognized the gain in the first year of $30,000, and they recognize a loss in the second year of $20,000, and together there's your $10,000 gain because they sold it for $110,000 and bought it for $100,000. It's interesting how they report that because they're going to adjust the fair value, and that means if it goes up, they have to record those gains in that for this particular investment. If we're going to take this now and show an income statement, often on a test, I will ask my students, just tell me what shows up on the income statement or on the financial statements. Well, in year 1, the only thing that shows up is that gain in value of $30,000, and it is an unrealized gain. So you can know they haven't yet sold the stock. Does that tell you what happened? Oh, sure. The stock went up $30,000. They haven't sold it. Once you understand US GAAP, you understand how to read financial statements. We then go to year 2. They did get $3,000 in dividend. The stock went down from 130 to 110. So in that year, we have a loss of 20,000. As far as the stock is concerned, they did get a net gain of 10,000 because they sold it for 110, but only bought it for 100,000. I don't think this is terribly difficult, but this is the rule for handling investments in equity securities. what should you know? I think you should know they're reported at fair value, whether they go up or down. And the movement from up or movement down is recorded as a gain or loss. That's US GAAP as far as investments in equity securities. Remember, Apple generates $220 million in cash on the average every day during 2020. They've got to find something to do with that 220,000 a day. And one possibility is to invest it in stocks in the stock market. And if they do that, this is how Apple would do the financial reporting. My name is Joe Hoyle. I'm one of the co-authors of your financial accounting textbook. What I hope is that every single day, your knowledge of financial accounting is growing and helping you to become a better financial decision maker. And that's exactly what we're shooting for. Have a great day.